When the stock market gets ugly, retail investors like you and me are full of fear, questioning all their investment decisions, and have their hand over that sell button like a Jeopardy contestant that has had way too much caffeine. I'm going to show you 3 things that you can do when stocks are crashing, everything is red, and your Robinhood portfolio is on its journey to the center of the earth. Hopefully, what I'm about to share with you in today's video can help you stop panicking so you can smack your fear in the face, raise your fist to the sky in triumph, and say, I'm not afraid. So without further ado, my name is Caleb, subscribe if you're new, and let's jump right into it. So the first thing I wanted to talk about today is to focus on the long term with your investments. Now, when the markets are red and everything's looking all scary, one thing I like to remember is when do you plan to sell these investments, and do you plan to hold them beyond the time that the markets are crashing? I feel like this is something that new investors in particular kind of get freaked out about, because when they see the markets down and they see their portfolios super in the red, they kind of feel like they're going to be losing money, and maybe it's way riskier than they thought, when in reality, if they just hold through it, most of the time, they'll end up back in the green again, especially when you're looking forward to a 10, 20, or 30-year time frame. Now, if you look back in history here, between the years of 1945 and 2001, we've had a total of 10 recessions, and on average, they last about 10 months at a time. So the point is here that recessions typically don't last that long, and if you don't need the money in the next few years, then honestly, why do you even care? At the end of the day, if you're focused on a long-term outlook, then what you really need to do is when you feel that feeling of fear and anxiety when you look at your portfolio and it's super in the red, just remember that it doesn't really matter on the long term, especially if you're investing in a diversified portfolio like the S&P 500, and it's something that you kind of have to train your brain to do. So you got to be able to look at your portfolio and see it down by 40% in the worst cases, and be able to just sit there and accept that and be like, you know what, I'm gonna be fine, I'm gonna keep investing, and I'm just gonna wait it out for 10 or 20 years. And the reason why I always say 20 years here is because there's never been a decline for the S&P 500 over any single 20-year period. I always like to mention this because it goes to show that no matter where you're investing at and how much you put in, whether you invest at the top of the peaks or the bottom of the dips, as long as you're waiting for about 20 years, you're going to see a gain most of the time. Now, I can't guarantee this, of course, because past performance is not a predictor of future results, but I mean, it's almost guaranteed. We're sitting right on the brink of it being guaranteed if you just wait for 20 years or more, and most of us that are in our 20s or early 30s could be even looking at a 30 to 40 year time frame here. So real quickly, I just wanted to show you guys something that kind of illustrates how much the short-term losses don't really matter in the longer span of things and how fast the market can actually recover. So we're going to take a look at the initial stock market drop at the beginning of the COVID pandemic. So if I jump over to the iPad here, we're on Robinhood, and this is the Vanguard S&P 500 that I always talk about. Now, if we jump over to the 5-year time frame, you can clearly see where the COVID pandemic hit. It was about mid-February all the way to the end of March. We saw a drop from about 310 down to 210, which is about a 35% drop, maybe 40%. But as you can see here, the amount of time it took to get back to that $300 mark was only a couple of months. So it looks like it was about, the beginning of August or so. From the end of March, I mean, that's only 5 months that we're talking about here. And the estimate that I just gave you a second ago was about 10 months for the average recession. So that just goes to show how fast the markets can recover. Now, granted, this COVID pandemic was a little bit different of a situation, and typically giant crashes like that of 30 or 40% last a little longer, and they take a little bit longer to recover. But it just goes to show that even if you bought at the peak right before the drop, you still would have almost doubled your money by now, or, at least a 50% gain. So the key takeaway here is to just kind of ignore what the market's doing on the short term, because on the long term, that's what matters the most. And if you have a long-term outlook and you don't need the money in the next 5 or 10 years, then I would say no matter what the market's doing and regardless of the price, you should be investing a consistent amount no matter what at regular intervals. Now, the second thing I wanted to mention here is that you need to remember that corrections and crashes are very normal with stock investing and really any market in general. So since COVID started, there's been a lot of new retail investors because everyone's trying to figure out new ways to make money, and we were jobless for quite a while, at least most of us. So because of this, we have a lot of inexperienced people in the market that haven't really, seen the market cycles and don't really know that crashes are normal and stuff like that. They're not used to seeing sell-offs. And on top of this, since the March 2020 market crash, we haven't even had a 10% correction yet, which is kind of abnormal. So if you look at the S&P 500 throughout history, we've had a 10% correction on average every 19 months since 1928. And if we take a look back at the iPad again, look what happened 19 months after the major market crash. So if you look right here, we were kind of getting worried about the crash at the end of like February or so. That's when people really started to like panic and freak out and start selling all of their investments. And if you look ahead to, exactly 19 months after that, we're sitting at about September 29th. So if I go to the 1 year chart, look where September 29th is. It's literally at the bottom of this crash that we're talking about. And, it did go up again, but we're still kind of just trading sideways for the most part. So this just goes to show that we were kind of overdue for a correction, and that's the main thing that I wanted to point out here. Now, some other relevant facts I wanted to mention just to show you how normal it is to have corrections like this. The S&P 500 has had a 15% correction on average every 2.5 years, and we've had a 20% correction on average every 4 years. So if you're investing for 20 or 30 years, you're gonna see crashes that are literally twice as bad as this every 4 years on average. So you could be seeing this 5 to 10 times before you retire, and this is completely normal. This is why I always try to look far beyond these time frames of even 10 and 20 years. So for me, in my example, I'm 25, so my time frame is closer to 35 or 40 years. This is exactly why. It doesn't matter on the short term that much if your focus is on the long term. Now, if you're someone who needs that money on the short term and you're like a stock trader, all of these things that I'm saying don't really apply nearly as much. But of course, in my opinion, you shouldn't even be trading stocks to begin with unless you have a long-term investment already established. Now, the third thing I wanted to mention here is to take these lower prices as a buying opportunity rather than looking at it as just a monetary loss. Because if you're investing long-term, you haven't really lost money yet until you've sold. And the way I like to look at it is when the markets are down, I like to see that as a chance to get into the market at a better price and you get more shares for less money. Now, I'm sure you've all heard this phrase a billion times by now, and that is to buy the dip. But seriously, this is super important. This is a crucial piece of money psychology that I think people should inherit, and especially if you're young or plan to hold for a long period of time, this is when it really becomes important. Buying the dip is not completely foolproof though. I'm not saying to just blindly apply this to random stocks and individual companies. I'm talking about your long-term index funds like the S&P 500, your very diversified portfolios that you should have set up, things that you just buy without the intention of ever selling them, essentially. This whole buying the dip strategy isn't always going to work for every single situation, and especially with stock trading and investing in speculative assets such as some cryptos and other stocks that you're trading on a very short-term basis. When those are down, I wouldn't say to always buy the dip, but as far as like index funds in particular with like Vanguard and ETFs and stuff like that, I feel like buying the dip is a very good way to add into what you're already doing. So like with me, for example, I'm investing $5 to $10 a day into the S&P 500. And what I mean by buy the dip is when the markets are super down, maybe I'll like up the ante a little bit and I'll double down when the markets are down. So I'm getting a little bit more shares for a cheaper price, but I'm doing this on top of investing that I'm already doing. Because if you're only buying the dip, but you're not investing consistently to begin with, then we start to approach that realm of trying to time the market, which doesn't always work. So if you're just waiting for a dip to buy in, and a dip doesn't happen for a couple of years, which we have seen a few times in history, then you could just be, sitting on your hands for a while and not have a chance to get into the market. So like I said, if you're waiting for better prices to buy in, a market crash is one of the best times to invest some extra money. And you can even take it a step further with value averaging, which I briefly touched on just a second ago, and that is to apply this buy the dip strategy on top of the buy consistently regardless of price strategy. So instead of just buying the dip, I like to call it doubling down on the dip. Now, like I said before, at the end of the day, nothing is guaranteed and previous performance cannot predict future results. So make sure you invest in things that make sense for you and your situation and with your investment time frame in mind. Now, one thing I always recommend to investors is to have an emergency fund set up before you even get started with investing, not only so you can have something to fall back on, but then when the markets are down and you want to try doubling down in the market and kind of value averaging in a little bit, you have some extra cash to actually do that. So when the markets drop, you have cash hot and ready to just throw at the market at any given notice. So I hope you guys learned something new from this video, and if you want to learn how often you should be investing, check out this video right here. And with that being said, thank you so much for watching, and I'll catch you in the next one.